Hi traders, this is Isaac from Trade Simple Trade Smart, and I just wanted to do a quick video of a follow-up to the Aussie New Zealand trade and setup that I went through a couple of weeks ago. So have a look through that video. I'm going to recap very briefly what the setup was, but more importantly go through what happened afterwards, because it paints an interesting picture of trading and gives us some pertinent lessons that we can take. So we were looking for a short identified from this zone, and all the reasons why are detailed in that video. Basically, since we were identifying this as a selling zone, initially the price overshot it and then started setting off. So as soon as we saw weakness coming into the market here, there was a trading opportunity. Now, we were short this market here with a goal of hitting a target in this area, that being target 1. So the great thing is target 1 has now been hit, which gives you basically the reason why you need to stick to your trading plan. The idea behind a trading plan is knowing exactly what you're trading, what strategy, how you're going to manage a trade once you're in there, and what your exit is going to be, whether it goes in your favor, which will be a target, or if it goes against you, which will be your stop loss, right? Or if you're going to be trailing your stop loss rather than going for a target. But either way, you want to map out all of that before you take the trade, because the worst thing to do is to be in the trade and guess or try and work out what to do next. You need to map out every possible scenario so that if something happens, then you've already got a solution for it. Otherwise, you're going to be reacting to the market rather than predicting and being proactive in how you manage a trade. So what do I mean by all that? Well, basically, the initial sell-off here was pretty good in a sense that it was quite convincing in terms of how price started to weaken and move in our favor. However, what happened after that is we had this aggressive retracement against our position. Now, if I zoom into that a little bit more, okay, the last thing you want to see when you're trading is your position or the price to go against you aggressively. However, the nature of the markets is that price never moves in a straight line. Sooner or later, you're going to get a correction. Right now, we had the sell-off from here, so sooner or later we're going to get a correction. I thought price would move more towards this level first before correcting and possibly move further down, but it paused, retraced quite heavily. At this point, many people would have been taken out of a trade. Many people. Most people would have been taken out of a trade. But what's happening here? This is the shakeout, right? This is where, let's say, smart money who got in on the highs here was pushing price down, and on working out that many traders were short this market, they pulled the market back to shake them out. Right? This is just a shakeout, the correction. This is just a mixture of people deciding to take profits early here, plus also large traders deciding that they want to shake out some other traders before pushing price further down. So this retracement is going to happen. What you need to determine is whether that retracement is basically going to move against you in an extended fashion, or whether sooner or later it's going to come to an end and move back in your favor. And the tool we use to do that is Fibonacci retracement tool, right? So what we noticed is we had this sell-off here, and as this started moving back, interestingly, it moved. If I put a fib from the low to the high to the low, we can see that we came slap bang into a couple of levels here, which was the 78.6 and the 886, right? So this is quite structured. This wasn't just a random correction. The point or which point this stops being a correction and a trend change is when it takes out this high. So as long as it doesn't take out this high, this trend, no matter how brief it is, or this move down, is still in fact intact. It's still in control. So this pulls back. It hit the levels here, and there would have been another entry opportunity to be short the market again, because this was quite corrective. It's telling us that prices come to an end in terms of its correction and is going to head down. Obviously, this is all probability. There's nothing you can say with absolute certainty, but we'd say there's a high probability of this heading back down, which is exactly what happened. Whenever something like this happens against you, what you need to do is work out if the fundamental reasons for taking the trade are now invalid. And the reason we took the trade was basically looking at the higher time frame. I saw that, okay, we've got this looks like it could be a correction, but overall we've come into an area of where we expect buyers to turn out, level of resistance, an area of demand, however you want to term it, but where we're expecting the price to turn from, full stop. So we're in a downtrend, so I'm thinking, okay, the fundamental reasons for the trade haven't changed. All that's happened is on the lower time frame, which in this case is the daily, we've had this big pullback. So it meant that let's say if you were short here and price came against you, you'd have another opportunity to go short here, depending on where you had placed your stop loss, right, or how wide you had it. I'll go through just a simple entry criteria in a second, but so price sold off after that instance, and then went on to hit the first target. The first target was sort of this zone here between this high and this high, basically anywhere around here, around 109. 109, we've got the round number of 109 here also. So looking at that as initial target, that was the whole that was how we were managing the trade. That target got hit, and now we're thinking, okay, what is the likely scenario going forward? Well, there are one or two scenarios that can unfold. This here, okay, we had a nice move up. This could just be the correction for price turning and moving back up. Okay, from an Elliott wave point of view, we've got 1, 2, 3. This could be wave 4. We could be, we're expecting wave 5. That's quite likely. For one simple reason is if we look at the momentum behind the move, there is some strong conviction behind this. So it's not unrealistic for this to move back up. That's one scenario. Hence why at this level I was thinking to either close the trade completely or look for a reversal opportunity, which you can do. The main thing here on a weekly, if we look at this from a higher time frame point of view, we've got a trend down. However, there's still an aggressive move back up. So this could be the beginning of an uptrend. Time will tell, right? We'll know truly once we clear this level. And if we clear this area, there's still going to be room to go from here all the way to the previous highs for trading opportunities. So even if as a trader you wait for a little bit more clarity, and you might sacrifice an early entry as a result, but you should have sufficient opportunities to capitalize on that afterwards. Okay, so don't be concerned with getting in very early or being the first in. Just focus more on entering once you're clear on what's happening. Now that's from a weekly point of view. From a daily perspective, we had this move back down, and if I squeeze the chart up a little bit, you can see in a greater picture we have a move down, a consolidation, breaks up, consolidates, goes down, and this is where we are, right? So a bullish scenario, we need to entertain that. We need to entertain that to the degree where there would have been a long opportunity here on a lower time frame, because on a daily we see that we're also hitting these oversold areas on both of them. Okay, so that didn't really so we had the oversold areas on both of them, and therefore from a lower time frame perspective we could look for entry opportunity. Now I'm going to dive into the lower time frames to see possible ways of having traded this. From the highs here we had the initial, if I bring this up like that, okay, this was the first move up, and there are many ways of getting into the trade. If I go through a very simple technique, it would be, once we had, this happens to be an hourly chart, it could be a 4-hourly chart, doesn't matter which one you use, but you see this level of support here, simple, a lot of traders will enter on break of that low. That's a valid entry, right? So you enter on, that's one entry technique. There are so many different ways of entering a trade. I would just say pick one and test it to see how well it works. A lot of times, we tend to enter on stop runs. So when you have, would have been looking for entry opportunity up here, or looking for opportunities to get in, say, on pullbacks, right? Because once you're confident in direction, you're waiting for pullbacks in order to get in at a more favorable or a better price. But let's keep it simple. Let's say you entered on break of the support here. You'd manage a trade, so the price goes in your favor, and let's say you're trading your stop losses above the major highs, you'd have come out somewhere around here, right? So that's not too bad. From here to this this would have been something in a magnitude of around 170. Let's be conservative, 170 pips. That's pretty good. Now, as it came back up, and this bit here is the second section we're looking at. This bit here. All right. So this was the bit we just looked at. Now the second section there is here. It shoots this sell zone, goes up this shaded green area, it overshoots it, comes back down, forms a local level of support. So that would have been a second entry. What this demonstrates is once you've got a setup that, a strong enough setup, the entry criteria is not as important, or it's not as crucial, because all it means is that you're just looking for either entering on price breaking below a level, or on pulling back to a certain level. That's it. Okay. But the most important thing is making sure you have a strong enough setup. So here was the second entry here, and you can see, you could trail your stop loss on price on above the highs here. You'd be able to trail it all the way down to sort of around these levels, right? Where if you were trailing your stop loss, you'd have sort of got approximately 240 pips, 250 pips. So 170 on the first, 250 on the second. That's pretty impressive in a couple of weeks. Here was a target. Now this has been the final target. Price came all the way down, hit it, and look what happens, which is quite interesting. Price hits this level once, twice, and then reverses quite strongly, right? Now on the lower time frame on here, seeing what happened on the daily, there was a reversal opportunity, and for that, let's say I would have chosen the 4-hour chart just to makes it a bit clearer to see. As you can see, price comes down, struggles to stay below it, a buying opportunity. You're long. Where would you look to get out? It's a difficult one to say, but let's say you keep trailing it, right? Because too many times we get focused on targets, and the hard thing about a target is no one really knows where price is going to go. So one of the safest things to do is just keep trailing it until the market takes you out. That's a very sensible way to manage a trade. So let's say we entered sort of around here, you'd be up approximately 160, 170 pips by now. Right now, this is just trading off one currency pair. Okay, just using one setup, and you've done the work once, which is interpret what's happening, and now you're executing that setup by breaking it down into specific plans. If it does this, I'm going to do this. If it goes up here, I'm going to buy. If it goes to here, I'm going to sell. And it's just simply executing that. That's a very liberated way of trading, because then it means you're not tense when you're in a position, which a lot of retail traders are. So all of this we go through on FX and Fibs program. Is under most of this will come under in fact all of it comes under the Trader Career Development Program. So if you want to trade in a more strategic way, I'd encourage you to have a look at that, or shoot us an email, or we can have a chat where we explain what we do on that. Until then, happy trading. Just as a conclusion, I put on there, we had a potential 9-to-1 trade. This actually achieved in excess of that, even though the first trade got stopped out earlier. So you didn't maximize as much profit on the first trade, but nonetheless, the first and second trade were in excess of 9-to-1. That's off one currency pair, right? So happy trading in the meanwhile, and hope you got something out of that. Speak to you soon. Take care. Bye bye.